And let's move on and talk about the big story that we're tracking on Trading Hour today, and that is on Zomato. The company has dropped its grocery delivery plans for the second time. Zomato, remember, had began the pilot project for its 45-minute grocery delivery service in a few markets, which started with the Delhi NCR region in July. It operated on a marketplace model, which allowed users to order directly from superstores. The company has cited infrastructure gaps in its competitive market as the reason for pulling off grocery off the menu. So how will this decision impact the company? The stock, as you can see, is pretty unperturbed. It's hovering at 142 versus its issue price of 76. So remember, despite the big run-up that we've seen in the stock price since listing, the stock continues to hold in the green today. To talk more about this development, we're joined by Sudheer Guntupalli, the lead analyst of technology at ICICI Security, and Mridul Jalan, the co-founder and MD of Sonora Advisors. Gentlemen, morning. Rima here. Sudheer, first question to you. How should we read this development? Is it a missed opportunity because grocery delivery is a big market and an opportunity going ahead? Or should investors see this development in a positive light because they will be focusing on profitability? Your thoughts?
Yeah, thanks, Rima. Good morning. So I'll read this as a positive development. Three reasons for it. First and foremost, as you highlighted, the company started piloting with this grocery delivery some time back before it decided to invest in grofers. But now it also has an investment in grofers, right? Which essentially means that on an organic basis, its own internal business line would be competing with its own investment, right? Which is not a very optimal situation to be in. And especially that is in the context that that takes me to my second point, which is about the opportunity you have spoken about. Of course, the opportunity is very large. By FY25, as per different estimates, e-grocery is expected to be a $24 billion opportunity, so on and so forth. But the other factor we should keep in mind is it's intensely more competitive compared to a food delivery business, right? We have to note that food delivery addressable market is $60 billion with only a couple of players, currently operating in a duopoly construct. But in e-grocery, we are talking about a $24 billion addressable market by FY25, and we already have early movers and we have multiple players who are competing for that pie, starting from Big Basket to Grofers to Amazon, Flipkart, and Zomato, and even Swiggy now. All right. So from that standpoint, while I agree with your thought that it's a very large addressable market, the competition is also fairly high. And there are multiple models also. There is inventory model, there is a marketplace model, so on and so forth. And when we are talking about the marketplace model, the mom and pop store, which is closer to the house of the customer, will always remain to be a big competition. So the competition is not necessarily from a Flipkart or an Amazon or a Big Basket or Grofers. The competition is also from the Kirana store or mom and pop store, which is very much in your vicinity and which has slightly better competitive advantage in terms of the cost dynamics when it comes to delivering this groceries to the customer, or when it comes to customer actually taking away groceries from the store. So this is the second point. So it's not just about competing with its own investment of grofers. It's also about entering into a market which is very highly competitive compared to, let's say, a food delivery business. Now, the third point is there are not many operational synergies between the organic business of food delivery with, let's say, grocery delivery, because it's not just the business construct is different in food delivery and grocery delivery. Even the operational print is pretty much different. In food delivery, it's more about the last mile delivery, which is the biggest value proposition that these companies take to the customer. But in grocery delivery, what happens is the bigger value propositions are actually discounts and assortments, and then comes delivery in that sequence. So from that standpoint, I see limited scope for synergies as well between the core business that Zomato is offering versus this product. So this was pretty much on our expected lines. We were always believing that while Zomato was piloting this e-grocery delivery, when they invested, the moment they invested in Grofers, we were expecting them to kind of scale down their organic e-grocery business. And we read it as a key positive for the company.
Okay, let me also bring Mridul Jalan into the conversation. Hi, Mridul. Good morning. Let me toss that same question to you. Do you look at this as a missed opportunity, or do you think that, like the company pointed out, and they have told their partners as well, that it's extremely difficult to pull high fulfillment rates consistently in this model? Do you think that it's better to stay away from this grocery delivery business, or is it a missed opportunity?
I think it's more of a strategic call which the Zomato management has taken. As Sudhir pointed out, that what they have done is rather than going directly into the market through the marketplace model, they have decided to go into this through Grofers, which is into the dark stores model of delivery. There is no point in adding a competition to a low margin or a high burn business by doing two different models. This is the way I look at it. And hence, what I look at it is a point where Zomato has clearly defined the strategy to address this market, which is through its investment in Grofers. By not doing directly, I don't think they are missing out on anything considerable when it comes to the value to the investors, because this market is anyways a highly competitive, low margin business, where it became very clear to the management that the pain points and the burn rate to the value it will bring to the investors doesn't match. And hence, for me, it's a positive signal and not any negative from an investor's perspective.
Gentlemen, good morning. Sudhir, Prashant here. Did you model in this sort of online grocery business into your numbers for Zomato? Did you have that as part of your numbers?
No, Prashant, we are not taking any upside from the organic e-grocery business that Zomato had till yesterday. And we value the investment in Grofers, the 9% investment in Grofers at the investment value, because that investment happened just 2-3 months back. So in our target price, probably that 9% of valuation of Grofers gets factored into our numbers. But apart from that, we were not building in any big upside because of the e-grocery business, nor are we pegging any optionality premium because of the grocery business. Because as we were always anticipating, this is a very tough market to be in, with very different set of unit economics, very different set of operational construct, and very different business proposition as well.
Riddle, the way Zomato went about the grocery delivery business was via the marketplace model. We all know that there is another model, which is the inventory-led model, which is what many of their competitors are using. And I think you referred to it as the dark model, dark shop model, dark store model. Can you tell us a little bit more about that? Had they gone through the inventory route, would the outcome have been a little bit different? And I can see your target price is 270. That's a lot higher than what we've seen from many of these bulge bracket brokerage firms put out. So Credit Suisse's today's target price is 185. For Goldman Sachs, it's 180. Can you tell us how you value Zomato?
So I'll answer both the questions, Sophia Rima. First of all, the marketplace model requires minimum investment. You just need to tie up with the local kirana and pop and shop and put them on your app, and clients will order. In case of a dark store model, you need to manage inventories through a channel partner or a distributor who will not only keep the inventory but will provide the delivery. It's like a pickup warehouse model. Now, both the models have a completely different dynamics. I don't think Zomato was anywhere close to the scale to justify a dark store model. And especially after the investment into Grofers, it doesn't make sense to go into a model in which anyways your investee company is going. It's like competing with your own investee company. And 9.2% is not a smallest stake in any e-commerce business. And the kind of a scale which Grofers is already reaching, it really doesn't make sense for Zomato to do both the stuffs. So it's a clear strategic call from the management. Now, coming to the point you pointed out on the target price for us, what we have done is we have tried to look at Zomato in a very different way than a normal financial stock. Instead of valuing the company on financials, we decided to value the company on the business. And when I value a company on the business, it's beyond the financials. A lot of companies, which are especially high growth companies, they tend to trade at exuberant valuations to financials because of the growth parameters they bring on the table. One way to justify that is through discounting the future years, which is instead of 1 year forward, I will go 5 years forward. We didn't want it to go that model. We said, let's value the business. And when I try to value the business, I need to value the distribution business, the data. Today's world is all about data. Now, the kind of data and the kind of patterns which Zomato has because of the clientele base and the reach and the distribution, it is of immense use to anybody who wants to do something in this space. And hence that deserves some valuation. Hence, what we did is we looked at where does a Jubilant or where does a DMart, which have a similar distribution-based model, or for that matter, a market leader like Asian Paints, which is a distribution king in paints industry, how do they are valued beyond financials? And that is where we assigned the value beyond financials for the distribution business, for the data benefit it brings on the table, and obviously the entry barrier which it has because of the scale and reach it has created for itself. So we believe financials will play the catch-up game, and if you start discounting on the financial basis over 1-2 years, the rest of the market will reach the target price where we are today.
All right, gentlemen, thank you very much for joining us with that quick take on Zomato. So that's the word on Zomato, as well as them taking groceries off the menu. With that, we'll get into a short break now. You don't go anywhere. When we come back, we'll discuss what's buzzing in the world of commodities.